Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is sponsored by ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest has 25 years of investment experience in the commodities sector and is a managing partner at Goehring and Rosenzweig, an investment firm dedicated to researching and investing in the natural resource industry. It's Leigh Goehring. Welcome to the show.
Very good, Jesse. I have one little correction there. It's not 25 years. It's actually 35 years.
Okay.
I became the lead portfolio manager of two Prudential Jennison natural resource funds all the way back in 1991. So I've been spending that's close to, 33 or 34 years doing nothing but researching and investing in global commodity and natural resource markets.
Well, you are the perfect guest for this show. And I do want to say, as I was speaking to you off camera, that Goehring and Rosenzweig, the work that you guys put out is phenomenal. I recommend anybody who hasn't read your reports to head to your website and do so. I had Adam Rosenzweig on the show as well. That was an extremely enlightening interview. So I'm looking very forward to this. And I want to start by just discussing the commodity sector as a whole. You mentioned you have 33 years approximately of experience investing in commodities and natural resources. People tend to look at the commodities space as very cyclical. Are there periods of time when there are literally no commodities to invest in? I guess is kind of the crux of the question, because there are times when, commodities are overbought or oversold and they tend to move cyclically. Are you able to find kind of certain commodities in those scenarios where there's always something that is undervalued and that looks like it presents an attractive value proposition? Or is there times where you just literally have to sit on the sidelines in this space?
I think that, given my experience, been through multiple cycles here, that I'll be really honest with you, Jesse. I think there are times when you do not want to be invested in global natural resource and commodity markets. Yes, if you run a hedge fund, they'd be a good opportunities in those periods when commodities get uh, relatively overvalued, and we can talk about that overvaluation, which the last great overvaluation peak occurred back between the end of 2010 and 2011. And of course, that was a great time to get out of commodity markets. If you're a hedge fund, you can use the shorting mechanism, but for those that are interested in long only, that there are times when you want to be involved and there are times when you don't want to be involved. Now, conversely, as I mentioned, 2010, 2011 was a time that you didn't want to get and be involved in the commodity markets. And today is exactly the opposite. Today, commodities, based upon our valuation work, and we can talk about that, we reprint a graph in our quarterly letters that we refer to all the time. The relationship between commodity returns and the level of financial assets is measured by the stock market. Commodities have never, ever been more cheap. And the thing is that this is the time, and it's great that we're having this conversation, because this is the time that you want to be making these investments. And of course, no one's doing it. Everyone is investing in AI, the NASDAQ 100, ETF, the open interest on that goes up every day, and there's absolutely no interest in this space whatsoever. That will change this decade, and that's where your value and your excess return is going to come.
Very interesting. And yes, we're seeing investment going to some very interesting places. A man who calls himself Roaring Kitty posted a meme on Twitter, and that caused GameStop to soar, which is perhaps a sign of the times of where we're in. Maybe we can start on that being the broad market AI, Nvidia, these handful of small tech, this small handful of very big tech stocks, I should say, that seem to be holding up the indices, the Nasdaq and the S&P. Obviously, this seems like a classic case of overvaluation, a time that you do not want to be in those sectors, and yet it seems like the S&P and the Nasdaq continue to grind higher to new all-time highs. How are people to make sense of this situation?
Well, I think that this is interesting, Jesse, you bring this up because I think you need a little bit of a historical precedence to look at this. And let's go back to the late 1960s, because I've often said that this commodity bull market is going to resemble, I believe, very much what happened back in the 1970s, which there was a huge commodity bull market that took place to the point where by 1980, everyone had to be invested in commodities. I mean, people used to go to cocktail parties and brag about how many Krugerrands they had stuffed in their safe deposit boxes. And so, at that point, that was another great period of commodity overvaluation by 1980. However, by the late 1960s, uh, we were in the same position that we were in today. Commodities had never been more radically undervalued. And the great commodity bull market actually started in 1968, very, very quietly. And it started with something that people don't remember to this day. It was the end of the death of the gold exchange standard. President Johnson, I believe it was March of 1968, quietly convinced Congress to remove the required gold backing of the dollar bill. And it was done very, very quietly. And of course, that's when the commodity bull market started. However, after that happened, even though commodities had entered this bull market, no one's paying attention. There was a huge craze taking place that topped out in the fourth quarter of 1972, and that was the Nifty 50. And of course, the Nifty 50 was very, very similar to the craze that we see today. Basically, it was 50 stocks trading at PEs of 50 times or greater. And everyone had to buy that, and everyone got sucked in. And that was the wrong place to be. And of course, the Nifty 50 was going on when the commodity bull market already started. Nixon took the U.S. off the Bretton Woods gold exchange standard in 1971, and gold ran from 35 up to about 150 in the next year and a half, even in the face of, you know, the Nifty 50 bull market still raging. So the thing is, I think there's an interesting parallel. You could say we're somewhere between 1971 and 1972 right now, and of course, that was a great time to be invested in commodities, and it was a terrible time to be invested in the stock market.
Well, I want to run through some different commodities with you and get your thoughts. Let us know if you're bullish or bearish, both short and long term. We'll start with gold, which many would refer to as not even a commodity, more of a monetary metal. But what are your thoughts on gold here? Obviously, we've seen all-time highs, a bit of a pullback since then. Are we entering a new gold bull market in your view?
I really do believe that we are. Now, we've been followers of gold markets for a very, very long time, and we've had some really interesting calls on it. In fact, back in I don't know whether you could show this. Back in 19, this is interesting. I mean, I'm going to bring this up because this is important because the numbers that I'm going to start throwing around the gold market, everyone said, "You're out of your mind. You don't know what you're talking about. How can that be?" But I'm going to show you that based upon our research and all the deep research we do in market cycles and historical valuation relationships, that we come up with numbers and we're willing to put them in print and they sound crazy at the time. And this is probably one of the craziest ones of all. I was profiled in Forbes magazine back in, I believe it was May of 2000, when gold is $275 an ounce. And in the reporters finally got me to admit what was my price target, and I said 2,500. Now, there was a very famous gold bear out there who named Andy Smith, who actually used to publish a very famous piece called Precious Thoughts on the gold market. He dedicated like a half of his Precious Thoughts piece one day saying that I had lost my mind. And the thing is that, but how good was that call? Well, it was pretty darn good. 275 in May of 2000 turned into a $1,900 gold price at the end of 2011. And gold was the best performing asset class during that decade. Now, the thing is, if you want to use those same valuations manipulation techniques that were behind that $2,500 target. We didn't hit it, but $1,900 is pretty close. Is that you could make the case that gold could go anywhere between 15,000 and 25,000 this cycle. That's how big this gold market could be. And it's going to be based upon a couple changes that are taking place that absolutely no one is talking about. And one of our big beliefs in the gold market and why gold has entered in a huge bull market is there's going to be an upcoming monetary regime change in the next it taking place at any point. And you say, well, why, what gives you such confidence that you're going to say that? Well, I would point out that every time the commodity prices have been radically undervalued relative to financial assets, the late 1920s, the late 1960s, and the late 1990s, each time had a huge monetary regime take place. And in 1930, it was Britain going off the gold exchange, the pure gold standard, being forced off, which ultimately required the, a default of the U.S. government and a debasement of the U.S. currency by 60% when Roosevelt took out the gold clause on Treasury issues in 1933 and raised the gold price, exchange price from $20 an ounce up to $35 an ounce. That was one massive monetary regime change. The other big monetary regime change I already touched upon was in the late 1960s. The Bretton Woods gold exchange standard was becoming very disadvantageous to the U.S. U.S. government. The U.S. Treasury was experiencing huge outflows of gold out of the U.S. Treasury. First, Johnson had to remove the gold amount of gold that the U.S. had decreased to such a point that by 1968, Johnson had to remove the gold backing of the dollar very quietly. And then in 1971, Nixon had to take the U.S. off the Bretton Woods gold exchange standard and revoke the $35 exchange privilege for foreign central banks. So the thing is, that was a monetary regime change. And of course, gold, again, was one of the best performing commodities went from $35 an ounce, peaked out at $850 in January of 1980, I'm sorry. And of course, the late 1990s, again, radical period of commodity undervaluation, huge period of speculation in stocks, the dot-com bubble. And what happened previous to that, between 1997 and 1999, the Asian currency crisis, where, I mean, it's amazing, like the South Korean won fell by 90%, the Indonesian rupiah fell by 90%, the Thai baht fell by 90%. And then what happened is that every one of those Southeast Asian countries, including China, which didn't value, but what they did is they suppressed their currencies at radically undervalued levels to the point where every one of those countries swung from running current account deficits. By 2002, 2003, they were all running huge current account surplus. Again, it turned to be massively positive to gold. Gold went from $250 an ounce at the bottom in the summer of 1999 up to 1900 by 2011. So a monetary regime change is coming. One of the things that's pushing the gold market right now is central bank buying. Central bank buying has just exploded in the last couple of years. And we have a very interesting divergence in the gold market today. Westerners are bearish. And it's easy to see how bearish they are. We follow 18 physical gold ETFs since real rates began to increase at the end of beginning part of 2021. Those 18 physical gold ETFs have shed almost 1,000 tons of gold. And I should point out that every time real rates go up, Westerners do sell gold. We could go all the way back to the 1970s to see that. You can see it all the way between 2012 and 2015 when real rates went up by 3.5%. And those same 18 physical gold ETFs liquidated 1,100 tons of gold. Except this time around, it's very different. That from 2000 end of 2011 to 2015, the gold price fell by 45%. Now we've liquidated almost 1,000 tons of those same ETFs, and the gold price is now 10% higher than it was 3 years ago. And the difference is central banks. Now, what's behind the central banks buying? We believe it's part of a monetary regime change that we don't even really know what form is going to take place. But here's my guess, is that China obviously has reached out to multiple countries, suggesting to countries that, hey, let's not settle our commodity trades in dollars, let's settle them in renminbi. They've gone to Brazil. Brazil has agreed to it, that they're going to sell their soybeans and iron ore and settle it in renminbi. They've gone to Saudi Arabia and they said, "Oh, Saudis, let's settle all the oil you buy not in dollars but in renminbi." And Saudi said, "We're thinking about it." But even like Total, the French companies agreed to sell all its LNG to China and be settled in renminbi. Now the problem with that is that the renminbi is a closed capital account. So you take your renminbi to China, you're not going to be able to get anything for it. Say buy some real estate in Shanghai, and no one wants to do that. So the thing is that China, if there's an imbalance in the in currencies because of an imbalance in the current account, China has to have some way to settle it and to balance it out. And maybe it's going to be the gold market. Maybe they're going to settle all. You bring me those renminbis, I'll give you gold outside of our closed capital account. And China's been a huge. China has now finished 17 straight months of accumulating gold. They have increased their gold positions since the end of 2021 by 16%. And it was interesting. The other for example, Brazil has become a gold buyer as well. India, who has historically not been a gold buyer, has started to accumulate gold, and they bought 17 additional tons in the first quarter of 2024. And what's interesting, Singapore, who has been out of the gold market for 53 years, it started to buy a couple years ago and bought. I think they bought 75 tons last year, increased their whole gold holding by 50%. So are we beginning to put together a monetary regime that's trying to undermine the reserve currency status of the US dollar? I think we are. And is this the form it's going to take? I don't know. It might take something, some other form, like the US government says we're going to take an explicit dollar devaluation policy. I don't know, but it's coming, because whatever we've been in this situation before, it's coming, and it's always been incredibly beneficial to gold.
Very fascinating breakdown. Appreciate that. I want to shift to silver here. Some are saying that silver is no longer a monetary metal. It's become much more industrial in nature. Would you agree with that? Do you think silver still has a place as money in the world? And how do you see the silver market performing up ahead?
I have a lot of very interesting and somewhat contrarian views of silver. I think silver is still the poor man's gold, and I don't think that we have. I don't think we've lost that appellation for the metal. However, one of the interesting things is that if you go study the the period where precious metals have basically been freely traded without price restrictions. So you go back to 1971. One of the interesting things about every gold bull market since then, it's been characterized by two things. One is that silver lags. Silver does not lead bull markets, it lags the bull market. And then, just as the bull market in gold is about to top out, or the big bull move in gold is about to top out, silver stages a furious catch up rally, which is a good signal that you're going to enter either to a huge bear market in gold or a huge period of correction. And I'll outline the three instances. Uh, 71 into 73, gold appreciated 35 all the way up to 165, $170 an ounce. Silver lagged the entire way. Then in the end of 73, 74, silver staged this massive catch-up rally, caught up with gold, surpassed it. Bang. That was the end of that gold bull market, or the first leg of the bull market. Gold pulled back 45% in the next year and a half, 2 years. Between 1977 and 1980, silver lags the entire way until the fourth quarter of 1979, when the Hunt brothers get involved and silver stages a massive catch-up rally, outperforms gold, and that by January of 1980, the gold bull market is over for the next 20 years. And again, in 2011, 2012, again, silver played a huge catch-up rally after lagging that whole gold bull market. Gold pullbacks 45%. So now it's interesting, between 2018 and 2020, 2017, gold had a nice bull move. Silver lags the whole way. Then it does this massive catch-up rally again, and that's it. And that we said, okay, we're out of the gold market. Gold market is going to go through this period of correction, which it started, but it's been truncated because of all the central bank buying. So again, this bull gold market has started. It's driven by central bank buying. And what's lagging again? Silver's lagging. Silver will continue to lag. Now, if you're a speculator, buy gold. And then when you feel that this gold market is going to be ending, so I'm talking about 3 or 4 years away at minimum, then you want to get involved in the silver market. But gold is doing what it's always done. It's leading and silver is lagging. Now, that doesn't mean it's not going to, in the end, silver will outperform, but it's going to do that massive catch up move, just like it's done previously.
Talk to us about your current thoughts on the uranium sector. To me, looking at the supply demand fundamentals and just the growing acceptance of nuclear power around the world, it seems perhaps one of the most no brainer commodities out there in terms of the potential value. However, the uranium price has run up quite a bit. Are we still in the early stages of a uranium bull market in your view? Has most of the money been made at this point? What's your current thoughts on uranium?
Jesse, you bring up a lot of very interesting points. And it also, for our followers and for your listeners, it illustrates how we manage money at Goehring and Rosenzweig. You know, we like to pick the bear markets and commodities. And the reason most people don't try to do it is because it's a career ruiner. You get it wrong, everyone says, you idiot, why in the world did you ever try to do that? Everyone's bearish. What makes you think you could be bullish? Well, if our followers know, we do an incredible amount of research, and you complimented us before. And one of the things is that the uranium market explains perfectly what we try to accomplish. We turned bullish in uranium in the first quarter of 2000. I'm sorry, yeah, 2018, right after uranium prices bottomed at $18 a pound in the fourth quarter of 2017. And we wrote three great large pieces on why the uranium bull market started. And we invested right at the bottom. I mean, at the time, no one had an interest, and you could buy a stock like Cameco at $9 a share, $20 discount to book value. That's why we try to pick bottoms, because that's where the value really is. Today, the uranium, what's so interesting about our modeling of the uranium business today versus what we did back in 2018, they don't look the same. The underlying fundamental story today in uranium is much more positive today than it was back then 4 or 5 years ago. So the thing is that that I think the uranium bull market still has one massive leg left to run. And the thing is, however, the valuations aren't cheap. Cameco, you could have bought all you want of Cameco at $9 a share. Now you're going to pay 50. So the thing is, Kazatomprom, the world's largest uranium producer, you could have bought that at $9 a share in the fourth quarter of 2018, and now it's 42. So the thing is that the underlying fundamentals are there, but the valuations are not as extreme as they were. And it's funny, the uranium market has actually caught the attention of the hedge fund community. A lot of hedge funds are chattering back and forth, and it's funny that these quotes appear in Bloomberg, and like they say, "Wow, uranium has entered into a structural uh, structural deficit," and I say, like, where did you get that from? Well, it's lifted right out of our letter. So the thing is that the underlying fundamentals are actually stronger today than they were 4 years ago, and that's driven by one of the things we love to do is we love to do like this very, very in-depth research. And not only do we do it on the supply side, but we also do it on the demand side. Most people don't do any demand work because it's complicated. You have to have like a metaphysical approach to the whole thing. Like what influences demand? What causes demand to increase to decrease? And we actually try to answer that. And one of the interesting things about uranium is that you go back and read our stuff 4 or 5 years ago. We outlaid it. I think it's some of the best research we ever did. We said renewables never work. They'll never work. Now we used entirely different investment framework and modeling to try to prove that. But for those that are interested, go back and read our letters. And for those that are like grants, interest rate subscribers, Adam and I presented at a grants conference. I think it was 2 years ago. I think it was one of the best presentations we ever did, and we outlaid why renewables would work. But if you're a believer that CO2 is causing climate change, that's a real problem, that means renewables aren't going to solve the problem. In fact, renewables actually make it worse because their energy inefficiency is so bad. But nuclear power is the solution. And what's interesting, that solution is now being grasped. I mean, Oliver Stone at Davos is running around saying, look, you got to build nuclear power plants, and he's correct. So the demand side is getting stronger and stronger. So there's another huge leg up. I think it's going to be driven next point because Kazatomprom is going to make an announcement at some point in the next month about their 2025 production ability, and I believe it's going to disappoint, and that could set another huge chaotic move upside in uranium prices. So we're still bullish. We're not as comfortable as we were back 2 years ago. So we've got company in that trade, and I have to admit we've actually been selling some of our stocks, but I still think they're heading higher.
I would like to shift to agriculture here. This is a sector of the commodity space that's very under discussed, particularly when it comes to media such as YouTube, et cetera. Because I was looking for value across the commodity spectrum more recently. I'm looking at gold stocks going up quite a bit. Some would argue they're still undervalued, though. And I kind of stumbled upon the fertilizer sector as an area that seemed very undervalued. You know, these big companies like Nutrien, Mosaic, et cetera. Are you seeing the same thing when it comes to fertilizer in particular? And are there any other areas of the agriculture kind of complex of commodities that you think could present some value?
Jesse, you're right. Fertilizers today, I believe, are great buys. They're relatively cheap. They had a huge run post the Ukrainian, the Russian invasion of Ukraine. They've given a lot of it back, and they're trading at, PE levels of, 7, 8, where the market's 25 times. And like you said, no one cares about it. The global agricultural market is shifted, we believe, and we've written extensively about this, into a I would call a bull market that's going to be characterized by crises. And the underlying fundamentals of that bull market is that if you go back over the last 50 years and you look at global grain consumption, is from say the mid 1960s all the way to 2000, it basically grew in line with population. People weren't eating more. And there's a good reason for that. We'll talk about that in a minute. But the funny thing now is that post 2000, global grain consumption has basically, the whole curve has shifted up. It has basically doubled what population growth is. And why is that? Well, that's because huge swaths of the global population that were poor have now in the process of going into the middle class. And when you go from being poor to middle income and then ultimately rich, which is a very, very difficult path to trek. Very few countries in the last since the end of World War II has actually made that transition from poor to rich. Japan, South Korea, Singapore, Spain, Portugal, and Chile's on it as well. You can stretch it a little bit. But the funny thing is, as you go from poor to middle class, there's a lot of things that you change. You change, like one of the things, you change your energy consumption. You go from riding around bicycles when you're really poor to mopeds to motorcycles to Toyotas to Mercedes, and that winds up in a measurable increase in oil consumption. And that's going on in China since 2000. That's one of the reasons why China has surprised on the upside every year as far as global oil, because of that phenomenon I just mentioned. The company is going to follow that as India. But the other big thing that changes as you get rich, you want to change your diet. You want to go from a starch-based diet to a protein-based diet. And the funny thing is that one of the interesting things about protein, especially animal protein, which we all love here in the West, animal protein, is that it requires a lot more grain. Depending on who you believe, to produce 1 pound of animal protein, it basically is somewhere between 3 to 6 pounds of grain to do it. So the thing is, that is in process. And you go back in some of our letters, there's some really, really neat graphs that show this relationship historically at work in a lot of emerging market countries. And this phenomenon is not at all done. Uh, and the thing is that global grain consumption continues to surprise the upside because of that the wealth factor. But the funny thing is that we've had this big shift up in global grain consumption since 2000, but it's also been met by an unprecedented stretch of great global growing crop conditions. So we've been able to meet that increase in grain consumption because of great weather. And we believe that the weather patterns are changing. Like all you have to do is turn on the TV, front page of the New York Times, editorial page of the New York Times, is that, oh my God, climate disaster is subsuming us. Never has weather been more violent, which I don't quite agree with, but there's been a lot of very interesting weather phenomenon. I think we're entering a period of off the chart weather volatility. And part of it is based upon you read. Hopefully, your listeners don't think I'm falling off my rocker here, but I'm a big believer that a lot of the weather is influenced by sunspot cycles. And over the last 50 years, we've been in an unprecedented period of very strong sunspot cycles, which you could argue maybe that's behind global warming. But but what's interesting about the other thing about global warming, contrary to what you read in the press, global warming is extremely good for global crop growing conditions. And you go back in our letters and we've talked all about that. And that's behind, I think it's one of the reasons behind global grain yields keep marching relentlessly forward. Genetics and increased fertilizer applications are big on it too, but it's one of the big factors. I think weather's changing. And I think we're getting a taste of what volatile weather will bring. And we've lucked out in the last couple of years. Like Brazil had a huge drought in its northern crop growing area last year, and they got rain just in the nick of time to save the soybean crop. Last year, we've had multiple years of very dry conditions in the Midwest, near drought conditions, and we just got rain just at the right time last summer in August to save the corn crop. One of these times you're going to miss that. And of course, if you really want to, okay, now you think this guy's really off his rocker, is that there's an interesting pattern in sunspot cycles called the Gleisberg cycle, where every sunspot cycle, they cycle every 11 years with like clockwork. And we really don't understand why, but it does. It has to do with the reversing polarity of the sun. And the thing is that every 8 sunspot cycles, 11-year cycles, they're characterized by a Gleisberg cycle. And again, we don't understand why, although it was recognized all the way back in the 1860s. Now, it's interesting. The last appearance of the Gleisberg cycle occurred in the mid-1930s. And what was the defining event in the 1930s in the U.S.? It was the Dust Bowl, the Depression and the Dust Bowl. And I think there's no coincidence that the Dust Bowl occurred with the occurrence, the emergence of the Gleisberg cycle, basically 80, 90 years ago. Now you go back all the way the previous 90 years to 1840s, tree rings in the Midwest indicate that there was another huge drought that took place back then. So the thing is that we could have in the next year or so, or 2, 3, we could have a reemergence of a severe weather event here in the Midwest associated with the Gleisberg cycle. Whether it happens or not, I don't know, but it's something to really watch very, very closely. We're set up for it. And the funny thing is it would be just, I think it would be cataclysmic for the world population, since the importance of the U.S. agricultural, how we're our huge number one soybean, corn, soybean, wheat, not quite, but we're huge influence on global trade and grain markets. Now, just to show you how we think weather's severe. Now, I'm going to give you a great example of severe weather. Between 2023 and 2013, basically 10 years, Des Moines. We always had, oh my God, it's getting so hot or whatever. Des Moines has experienced 6 days of temperatures that hit or exceeded 100 degrees over that's 11-year period. In 1934, when the Dust Bowl really, really started to get going, Des Moines experienced 36 degrees greater than 100. In 1936, they experienced 31 degrees greater than 100. I mean, that would be devastating to the corn crop. And so, yeah, everyone, people are bearish on agriculture. You look at, for example, in the soybean pits and the corn pits of Chicago, back in February and the beginning part of March, speculators had never put on more short bearish positions. And so people are bearish. Fertilizers, I like. The valuations are really cheap. And you have a potential for a huge weather disruption taking place in the next couple of years or so, which would be massively beneficial to grain prices and massively beneficial to fertilizer prices. So yeah, that's my overall view on agricultural markets.
Great. You did talk about energy a little bit there, so I'd like to dive further into that. Oil and natural gas, a couple of other commodities that have been massively underinvested in. A lot of funds have these ESG mandates that they've divested themselves of oil and gas, and especially coal as well. Maybe you could touch on that a little bit too. How do you see energy positioned? In one of your letters, you mentioned that natural gas could be the next uranium in terms of where prices are today and where they could be headed. So maybe if you could touch on oil, natural gas, and any thoughts you have on coal as well.
Yeah, let's start with natural gas because I'll talk about oil and coal at the same time later. Natural gas is our favorite commodity right here, and just like I mentioned before, Jesse, about how back in 2018 we wrote all these bullish pieces on uranium. Not one person paid attention, at least the investment side. The insiders on the commercial side did. But the thing is that it's the same position in natural gas. What are the things that we like to do in investing? It's based upon our research product and the research that we do. And our research often, like I mentioned, I talk about what I do like a standard investment pitch to a potential investor. I say, the more a bear market grinds on, the more valuations get depressed, the more the companies become pessimistic and believe it's never going to occur, the more we like to roll up our sleeves and do a lot of work in that area and try to find trends that have emerged that no one else has recognized that tell us that that bear market is nearing an end and a new bull market is about to start. And everything I just said applies to the natural gas market. Obviously, the natural North American natural gas market has been dislocated from the global natural gas market for going all the way back to basically 2010. And that was the great surge, the second great surge of the shale gas revolution in America, which has been nothing but spectacular. Classic American ingenuity to the point where, 2005, people forget, the US was like the third largest LNG importer. Now, starting in 2016, we started export LNG, and now we are the world's largest LNG exporter. And that's all because of the shale gas revolution. But one of the things that's interesting is that the price of gas outside the United States still sits 80% higher than the price here in the United States. And we believe that that's going to change. And it's going to change because of some of the research that we've done that no one else has attempted to do. And I think it's what from a value add standpoint that we bring to the table. And what I'm referring to is that the reason why the natural gas market in the U.S. has been in what I would call structural surplus for the last decade is because of three huge shale gas development projects. One was the Marcellus, the second was the Haynesville, and the third was the associated gas that came out of the Permian. And those fields have grown so hugely over the last decade that those three fields now account for almost 65% of U.S. gas production. The U.S. gas production has never been so concentrated in three fields. And we believe, based upon our research, that the huge ramp ups in production that took place starting in 2010 in all those fields is now plateauing and is about to roll over and begin to decline. And so you combine that with the fact that in the next year we're going to bring on an additional 6 BCF of new LNG capacity. Supply is going to stop growing. Then all of a sudden, that U.S. gas molecule, which is trading at an 80% discount to the world gas value, the U.S. world gas molecule, and the U.S. world oil price, that is going to converge. And I think there's tremendous opportunity in that. And it's going to happen fast. Look at what's happening in the copper market. We've talked about the copper has a next huge leg up based upon low inventories. The demand is much stronger than people expected, and we've written all about it. So the thing is, the same thing is going to happen with gas. Copper literally back in January, I think hit $3.65, and now it broke through $5 yesterday and today. So the same thing's going to happen with gas. And the thing is that no one knows it. The way to do is to play the natural gas equities, the pure ones here in the States. They even though they've had huge runs, um, and picking at the bottom, we did turn bullish in gas right at the bottom, and you could go back and read our pieces, and the valuations there were radically undervalued. They're not as the gas equities are not as undervalued as they are today, but they're still extremely undervalued. So you have a great commodity uh, bullish picture that I can outlay for you, and the valuations of the equities, the pure plays in that commodity, natural gas commodity, are extremely cheap. I think it's a fantastic place to invest. Now, oil is it's very interesting. Now, again, you can say, well, this guy's crazy, he's off his rocker. If you go back to 2018, 17, 18, 19, there was a lot of chatter among oil market analysts, talking heads, that oil had become an uninvestable commodity. And the reason is that the shales were going to grow endlessly. The the EV was going to be adopted radically across the world, and we would hit peak oil demand, starting potentially as early as 2019. The IEAs, were using those figures. Now, the funny thing is we disagree with that completely. First, we believe the shales are in their twilights right now, just like I talked about the gas shales. The same exists. Same exists in the oil shales as well. And the funny thing is that not only do you have, and remember, the U.S. oil shales represent almost 80 to 85% of non-OPEC oil supply growth over the last decade, all the way back to 2010. And the funny thing is that's coming to an end, and oil demand growth is just it's surprising to the upside, contrary to what the IEA just put out this morning. They reduced their demand estimates. They underestimated demand last year by 500,000 to 600,000 barrels a day, which continues a streak going back all the way to 2010, except for 2020. So the thing is, demand is very robust. The EV, as you notice, is not taking off. There's a very, very good reason for that, and we've written extensively about that. And based upon the idea that a new technology that is inferior energy efficiency cannot displace the old technology. That's what's happening with EVs. Explains what's happening with EVs right now. So the thing is, oil demand is going to stay strong. Non-OPEC oil supply, which has grown rapidly because the shales, is about to stagnate and possibly roll over. And the last time you've had big disappointments in non-OPEC oil supply was the 1970s and the 2000s, and you had huge bull markets in oil. And I think you're setting up for that right now. So I like oil, but I like gas better. And coal is very interesting. If you're a follower of Edward Chancellor, the great market historian, market commentator, and market historian, he talks about what you want to do is you want to invest in a commodity bear market, but it also at the time when the industry has been completely starved of capital. And valuations are cheap, and you don't want to invest in a commodity market where valuations might be cheap, but you're in a huge capital investment cycle like lithium today. That's getting massive capital investment. Coal is just the opposite. That industry, I mean, I think these coal companies, there's not many left. They couldn't even go to JP Morgan or Chase or bank like that to open up a checking account. They wouldn't even give it to them. They probably have to, these coal companies have to go to the third, fifth national bank of Wheeling, West Virginia, to open a checking account. And the funny thing is, so they have had no capital investment. And the thing is, the valuations are in the coal stocks are incredibly cheap. And the thing is, not good for the environment, but my God, coal consumption still, continues to surprise to the upside, and which I think is not good, but it's a fact of life. Now, here's another fun fact about coal stocks. Every commodity bull market, and there's been three big ones. Ironically, one of the big ones was in the Depression. It's hard to imagine, but it was based upon the fact that the U.S. devalued the dollar by 65%. 30s, 70s, and 2000s. What were the leaders? Coal stocks. You say this commodity bull market started in 2020. The average coal stock we follow is up 2,400%. They're leading. just like they did in every commodity bull market. And you're right, Jesse, no one can buy them because of ESG pressures. So, the coal stocks have pulled back a little bit here as coal prices have pulled back, but they're all trading at PEs of like 7 or 8. Again, market is 25. And you could make a case that the underlying fundamentals are extremely good, at least for the next several years.
Well, I want to just close on copper here. You mentioned that it's ripping recently. Is this a train has left the station scenario? Is there still opportunity to be had? In your research, you mentioned that you're bullish in the short term, but also not necessarily over the long term. So maybe you could talk to us about that.
Yeah, this is a very contrarian viewpoint. We're extremely before this copper price took off, we pounded the tables. We said copper has a very, very bullish setup in the short term, which is exactly the opposite of everyone else. Everyone was cautious short term because of China problems and property development problems and all the global recession. Everyone was cautious in the short term and raging bulls in the long term. I mean, some of the stuff that's coming out from these various commodity price consulting firms, which, mind you, if you follow them going back over the last 30 some odd years, have never been right about anything. Now have all decided to write about copper, and they're saying, oh my God, there's a 20 million ton deficit out there by 2035. Now, it could happen, but they're basing that upon a massive radical adoption of renewable energy, which is very, very copper intensive. But okay, the short term setup is mine supply problems and incredibly strong demand. Even though there's all this talk last year about copper demand from China being weak, copper demand last year in China grew by 12%. And, that's going to, based upon our modeling, because like I said, we do a lot of demand work, that's going to continue probably all the way to 2030. Chinese demand is going to continue to surprise the upside. Why? China's per capita GDP now is about $12,000. They want to avoid the middle income trap, which means they've got to somehow get between 12,000 up to 17, $18,000. The only way they can do that is almost to double their copper investment in their economy. We've done that historically. We've done the relationship between per capita GDP growth and copper. You cannot have, if you want $18,000 per capita GDP, you have to have, off the top of my head, I think it's close to 500 pounds of copper per person invested in the economy. China today is like, I think, 250 or something like that, 280. But that's not only. India is now where China was back in 2000. India's copper demand now is over the last 2 years has surged by 60%. You could make and India's investment in copper is inadequate even to support its $3,000 per capita GDP. If they want to go to 5,000, they're going to have to double their copper consumption, and they're doing it right now. You can see it in the figures. And there's other emerging markets too. We talked about it, and we wrote extensively in our last letter about Indonesia now is all of a sudden emerging as a huge copper consumer. But anyway, so you have all this copper demand, you have all this investments in renewables, which is happening. It's all copper intensive, so the demand side is very, very strong. And the mine supply issue, we've got lots of mine supply issues, and we've written about this extensively. Everyone now talks about depletion. Some of the best work we ever did copper was back in 2005, 2006 in the first bull market about the depletion issue, which was emerging back then. So, however, that's between now and I would be surprised if you see copper over $10 in this bull market run here. Long term, it's interesting, and there's a mining entrepreneur out there named Robert Friedland, and Robert Friedland is in the process of introducing two potentially disruptive technologies into the copper business. And one is this whole iPulse technology to basically try to discover hard rock mineral deposits that are significantly below the surface. And ironically, one of the things about the hard rock metal industry, as opposed to the oil and gas industry, the oil and gas industry has had the ability to see tens of thousands of feet below the surface. The hard rock industry has never been able to develop that technology. Ivanhoe Electric's iPulse technology, we believe, has the ability to actually see and image copper deposits that are significantly below the surface. which we completely missed in the past. So we could have, by in the next couple of years, we could have a bunch of huge new copper discoveries that out there. Now, whether they come on fast enough, we'll have to wait and see. But the other thing is that he's introducing this IROX technology too, which could very well change the ability to mine lower grade sulfide ore. And the reason I point this out is because most people don't remember this. The copper industry has been subject to disruptive technologies in our institutional memory. SXEW, solvent extraction electrowinnowing technology, was introduced into the copper business in the late 1980s, which allowed copper companies for the first time to mine and basically extract low-grade oxide copper ore from ore deposits, which over the last 100 years, they knew where all these oxide deposits were, but they couldn't produce them because oxide deposits is not amenable to flotation technology, which is the classic method by which you separate copper from sulfide material. So the thing is that all of a sudden, SXEW copper was rapidly adopted, and SXEW oxide copper went from 0% of global copper production in 1990 to representing by the early 2000s 22%. 22%. So are we on the verge of a new surge of investment, productive investment in copper that goes to find? Maybe we're going to learn how to mine low-grade sulfide ore. There is plenty of low-grade sulfide ore in the world. All those mine pits, the reason the sidewalls of those mines are not mined, it's filled with copper ore, but it's low grade. Can we learn to actually mine it in a cost-effective way through maybe Friedland's IROX technology? Maybe something to really monitor. And second, iPulse technology. Will we be able to find a whole new generation of extremely large copper deposits greater than 200 feet below the surface? We don't know. We're looking into the future, but it's something to watch.
Well, Leigh, this has been a fantastic conversation. Learned so much, such an in-depth breakdown of these commodities. So we truly appreciate that. For those who do want to hear more from you and your partner, Adam Rosenzweig, tell us about the work you do at Goehring and Rosenzweig and where people can find that.
Okay. First, I want to remind everyone that people know us for our research, but we're not really a research firm. We're an investment firm, and we run. We historically have run money for very large institutions, retail people, and we do that at Goehring and Rosenzweig. So if you're ever curious, please contact you, and we can inform you of all our investment product. And however, if one wants to read our research, listen to our podcast. They're all on our website, and we don't charge anything for it. You could just go on there, you put your name and your email address, and you'll be sent everything. And you should enjoy it. If you're interested in commodities, I go back and read our old letters, looking for things that I've written about, and even I look back and say, wow, that was pretty insightful. So the thing is, we don't get it right. We make mistakes, and I admit it, but we also do things that people don't do. We try to look out to the future, and we try to make investments not in what's happening today, but what we believe is going to change positively. So you could definitely you go to our website, read our stuff, listen to our podcast, because we do a lot of podcasts, and you'll get an idea of what Goehring and Rosenzweig is all about.
Great. I'll put a link to the website in the description below. And one thing I love about your research is it's so accessible, both in terms of the fact that it's freely available, and it's also very fun to read. Your writing style is and anybody can read it and get a grasp on what you're talking about. It's not extraordinarily technical or difficult to read. So I think anybody interested in the commodity space should definitely head to the website and check it out. And thank you once again, Leigh, for coming on and sharing your knowledge with the audience.
And thank you very much, Jesse, for having me. I really enjoyed it. Thank you.
And thank you for joining us today. This episode of Commodity Culture is sponsored by ARC Silver Gold Osmium. Go to arcsgo.com for all of your precious metals needs and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.